Well, good morning, everyone, and welcome to the Cleary Hall Legal Resource Club webinar for this month. This month, we're going to be hearing from Adrian Bailey from the Sydney office, and he's going to be talking about always interesting topic of tax considerations in business sales and acquisitions. I'm sure you'll enjoy the paper. I'll give you a bit of a rundown on the system first and a few new things that we're going to introduce today. So you should see down the side a section called Files, and in that section you'll be able to download the paper from today. So you can head to that section and download now if you like. There is, throughout today's session, we're going to run a couple of polls. Essentially, I'll butt in at an appropriate time and put the question out there that is in the poll, and you'll have about 5 minutes to respond to each poll item, and we'll recap those towards the end. It just gives us a bit of an understanding about what's happening in your world, but also just some interesting, topics to discuss. In terms of the Legal Resource Club, you hopefully will have seen in recent times our mailer about our face-to-face workshops. We didn't get to run them last year. COVID hit right at the worst possible time for our workshops, so no one was doing face-to-face anything back then. So we hope to get back out on the road and do our roadshow in May. You should have seen that email, but next week you'll get another email which will identify what we're going to talk about. So we're going to send out the agenda, and there's some really great topics in there. Unfortunately, this year we won't be able to do a session in Melbourne. Melbourne still has requirements for the amount of people in a room, and we just unfortunately cannot locate a room that would justify having enough people in the room to justify attending there at this stage. If that changes, we will certainly add Melbourne back to the list, and maybe even later in the year once Melbourne's restrictions ease a little bit more. So if you're in Melbourne, we apologise. With today, I think I've covered most of the things. Obviously, you can put your questions in the chat box as well. I did forget to say that. Chuck your questions in the chat box, and I'll try to raise them with Adrian at the right time. So I might hand over to Adrian. Thank you.
Thank you, Paul, and welcome everybody to the webinar today. Topic, as we've discussed, is tax considerations on business sales and acquisitions. We are going to focus mainly on the sale aspect because that's where we find most people are concerned about, of course, making sure that they sell in the most tax effective way. And the taxes that we're going to cover, as well as another topic, will be capital gains tax. That's where we're going to spend most of our time, recognising that the sales of businesses are generally, there is a large capital gain, and in most cases it's the client's nest egg, so to speak, so they want to make sure that they end up with the most cash in their pocket. Income tax, goods and services tax, transfer duty or stamp duty, as it used to be called, and then just capping off on structure choice towards the end, because if we're acquiring businesses, we want to consider our structure choice when we're doing that. We will be working through a case study in relation to the different approaches that can be taken, but as I said, most of the paper today will be talking about capital gains tax. From either side of the table, and we do act for clients when they're selling, and we do act for clients when they're acquiring businesses. But in terms of the tax considerations we need to think about on both sides, for the seller, obviously it's capital gains tax, income tax, or goods and services tax are the things that need to be considered. For the purchaser, GST, transfer duty or stamp duty in the states that still have it on business assets. And then, again, as I mentioned before, structure choice from a tax perspective, and making sure that our structure is the most suitable for capital gains tax and income tax purposes moving forward. Jumping straight into the tax part, so the CGT considerations for a seller. The two main areas that the sellers are going to look to apply are the discount capital gain contained in Division 115 and then if they qualify for it, the small business concessions in Division 152. So we'll cover off on both of those. So we'll recap on what the requirements are in order to qualify, and then we will come back to the example and work our way through them. In terms of the discount capital gain, relatively uncontroversial. It provides that we have a 50% discount on any of our capital gain if we are a trust or individual taxpayer and we've held the asset for more than 12 months. So as I said, relatively straightforward, 50% discount off our tax bill if we qualify for that. And that's really where we start to see the first of the tax advantages in the way that we choose our structure and the way that we hold assets, recognising that a company doesn't get access to the discount capital gain. I should point out, if the asset is held by a super fund, not too many businesses being sold from super funds, I would think, but certainly business assets being generally the property operated in the business, the discount capital gain is limited to 33% for the super fund as opposed to 50%. Moving on to Division 152 and the small business concessions. So it is a complicated area, and to be honest, it keeps getting more complicated the more that they tinker with it. And it is the case that, particularly if we're giving advice to clients and written advice, every time we'll return to the legislation to work our way through the provisions. Because although you have a fairly good understanding, the devil is in the detail in the legislation, and but by no means can you rely on thinking that you meet them. Obviously, there's a fairly large difference between meeting them and not meeting the small business concessions. From a mathematical sense, for a mother and father operation, it could be up to $4 million of tax saved. So we want to make sure that we do qualify for them. And for that, we're going to need to know what the basic conditions are, certainly far from basic. We're going to need to know what the small business entity test or the maximum net asset value test is, obviously the active asset test as well. And then if we're selling equities, and by equities we mean either shares or units, there are some further conditions that need to be met, which have recently been amended and what you consider to be tightened up in the last few years. So it adds another layer of complexity to our small business concession access. So running through the basic conditions, they are that we are a taxpayer, first of all, and that we have a sale of an asset which results in a capital gain, and we either meet the small business entity test or the maximum net asset value test, and the asset is an active asset. As I mentioned, there are some further conditions in relation to equity sales, which I'll come back to, and also some further conditions in relation to if it's a partnership asset. In terms of the small business entity test, that's our turnover test. So that is the $2 million threshold, which remains at 2 million. For some aspects of small business concessions generally, not strictly limited to CGT, the turnover is 10 million, but it continues to be $2 million for the turnover test. So to also meet that, we also need to be carrying on a business. So when we think about it conceptually, straight away, if we're selling shares or we're selling units in a business, we're not going to be able to rely on the small business entity test, because either the individual or the trust or the company that holds those shares or units is not going to be carrying on a business in its own right in the most circumstances. And so we need to consider, when we're looking at our advice as to which way the client should go, who is the actual taxpayer. And for most cases, as I said, where we're selling shares or units, we won't be able to rely on the small business entity test. $2 million is not a big threshold for a lot of private businesses, I would think. And just to refresh everyone's memory, it's the turnover of not just the entity, but any affiliated or connected entities as well. So if we have a fairly large client structure, we may also need to take other turnover into account. Some things are excluded, such as GST from turnover calculations, petrol excise, those sorts of things. So you tend to see the small business entity turnover test only used in limited circumstances. I tend to find you're relying on that more in a farming operation, where our turnover might not be as high, but we have very large land values. On that point, on the other test that we can meet is the maximum net asset value test. So that's our $6 million net asset position. If we add up the net assets of any of the taxpayer, entities connected to the taxpayer, and relevant assets held by affiliates, if that total amount is more than $6 million, so our net position, assets minus relevant debt, has to be relevant debt, then we meet the maximum net asset value test. And just reminding everyone, we don't need to meet both. We don't need to meet the small business entity test and the maximum net asset value test. It's an either or. So if we meet the maximum net asset value test, then we will qualify for that. With that test, it is worthwhile remembering, like the turnover test, it's a hard cliff. If we're at $6,001,001, we don't meet the small business concessions. So it's really important where the clients are close to that amount, that we have firm valuations, that we're really drilling into the area there to make sure that we're under the 6 million threshold. The other test that we need to meet to gain access to the small business concessions is that we have an active asset. So that is an asset that is used or held ready for use in the business. So in terms of that, recent case where the firm actually acted a Weichmann, confirmed what the nature of an active asset is in that sense, and the term held ready for use or use in the business. So you tend to not have any issues in qualifying something as active. It either is or it isn't. It's either used in the business or not held not used in the business. But it does need to be one of those assets. So something like a passive ASX share, for example, if we're not a share trader, that's never going to be an active asset. I mentioned equity sale has further conditions. In essence, if we're selling shares or units in a company, then 80% of our assets in that company or unit trust need to be active assets. So we do need to, again, test the entity itself in order to meet the basic entry levels of the small business concessions. The other thing which I mentioned has been tightened up recently is it is also a requirement now that that entity itself meet the maximum net asset value test if we're doing an equity sale. That was introduced to try and combat what was perceived as a mischief, in that we could sometimes engineer the shareholder to be a small business entity. However, it is fairly restrictive, and there is a tracing through to other entities, which is at a lower threshold. So if we're selling equities, we really need to consider that a little bit closer these days. Moving on to our available concessions. So assuming that we meet all of those, what are the concessions that we can use? And Paul, it might be a good time to launch one of those polls, I would have thought.
Yeah, I was just about to jump in. Thanks, Adrian. So I'll start the first poll. As I said, I'll leave it open for about 5 minutes from now, and I'll let you know some results towards the end. Okay,
thanks, Paul. In terms of the available concessions that we have in the small business in the Division 152 world, 15-year rule, small business 50%. Small business 50%, that's all it's called these days. The small business retirement exemption and the small business rollover. And we'll touch on the requirements for each of those so we can see where and when they do apply, and again, maybe just touch on some issues that we see with clients when in trying to apply them. So the first one is the 15-year rule. It's what you consider to be one of the most generous, in that if we qualify for the 15-year rule, then we have a tax-free event on a sale. Paul, just a reminder, I think your audio is still on. With that, the 15-year rule, we need to meet the basic conditions. So we're going back to that maximum net asset value test, the active asset. We've held it for more than 15 years. We have a significant individual. So a significant individual is somebody, in essence, who holds at least 20% equity in the entity, if we're dealing with a company or unit trust, or if we're dealing with something like a discretionary trust has received 20% of the income and capital. We need a significant individual for each of those 15 years. It doesn't have to be the same one, but we still need to have one. And that's really where we see some of the issues crop up with applying the 15-year rule, because we need to have 15 years worth of records which show that significant individual. For a company, generally it's not too difficult. Normally we'll have the company register and asset records. However, where you can struggle with that is where we're selling out of a discretionary trust, for example. If we don't have 15 years worth of records for that, we can't show a significant individual for 15 years, and we may not qualify for the 15-year rule. It also needs to be an event in connection with retirement or actual retirement. And why there's that difference there is that we can have a CGT event which is in connection with your retirement, but you're not actually retired yet. So classic example would be a sale of an accounting practice when the accountant has decided to retire and the new practice wants them to stay on for a year or two to transition the clients. So that sale would be in connection with their retirement. If we meet all these requirements, we have to apply the 15-year rule. It has to be applied, and the result is a tax-free outcome for the client or no capital gains in those circumstances. For the small business, 50%, which is the next concession we'll cover off on, all we need to do for that is meet the basic conditions. If we do that, the end result is a 50% reduction in our capital gains tax liability. Small business retirement exemption, again, we need to meet the basic conditions. If we have a significant individual, which again is that 20% threshold, we need to have one in the year of sale. And there is a limit of 500,000 using the small business retirement exemption in terms of gain that we can deal with. If we're under 55, we need to pay that into super on the later of either receiving the proceeds or making the election, which is done in the tax return for that year. Or if we're over 55, we can pay it directly to the individual, or we can pay it to super. If we pay it to super, sometimes that's a strategy that's implemented because this 500,000 limit doesn't count for your 1.6 million transfer balance cap. So that's sometimes an option that clients use to still pay it into super in that circumstance. I should clarify, I said you make the election when you do your tax return. This is one of the strange elections that actually require you to make it in writing separate to the tax return. So filling it out in the tax return isn't sufficient. You need a separate resolution or a separate election which states that you're applying the retirement exemption and how much you are applying. Moving on to the last of our concessions that we'll consider as the small business rollover. So if we meet the basic conditions and we acquire a replacement asset, so that asset has to be an active asset, or if it's shares in a company or units in a unit trust, the 80% of the assets of that have to be active. If we require a replacement asset within 2 years, our CGT liability rolls over in essence. If, for example, we had a gain of 2 million and we bought $1 million asset, then we would have a reduction of 1 million and we would have a CGT liability for 1 million. If we don't acquire a replacement asset within 2 years, that's when we have our CGT event. So sometimes this can be used as a planning tool. If, for example, the client is getting close to 55 and doesn't want to put money into super, if we have our CGT event and then apply the rollover, by the time the rollover period comes around, the client may be over 55 and we can then apply the concessions to the gain and not, for example, have to put that money into superannuation. So sometimes, and just basically, it can also be used as a deferral tactic in reality. 2 years of not paying tax, a CGT event is 2 years later. So just remembering, any times we're discussing deferral with clients, we need to make sure they squirrel that money away somewhere because we don't want to be having that conversation in 3 or 4 years' time where they've suddenly got a very large tax bill and no money to pay it. So if broadly we have a client that comes to us and says, I'm selling the business, should I sell the assets or should I sell the equity or the shares or the units? Of course, it's going to depend on structure. If the client's operating in a discretionary trust, we won't be able to sell the shares or units, so we need to rely on selling the assets. Generally speaking, from a tax perspective, an equity sale will lead to a better tax result, and we'll see that as we work through our example. However, believe it or not, tax is not the be-all and end-all. If the reality is we can't get the deal done and the client wants to do the deal, unless it's an asset sale, then it's the client's choice. okay, we're going to pay more tax, but it's the client's choice that they want to do the deal regardless. Usually a little more complicated, and by that I mean prior to selling our shares or units, we're generally going to have to tidy up our balance sheet because our new buyer is going to be taking over our company. So there are things in it that we're going to want to not have there anymore, such as retained profits. There might be some other assets. You might be in the position of a recent client who had $3 million worth of luxury cars in his company and was looking to sell the shares. So there are things that we need to do in those circumstances before we actually get to the sale. Having a look at our case study, we have Metlac, which operates an IT business, and it has, Metlac Proprietary Limited, it has one shareholder, George, who's 45. He's operated the business for 10 years and started it from scratch. His sale price is 1.75 million. That's what he's been offered. And he's decided he's going to retire. 45 seems a little young, but maybe George has had a midlife crisis, or maybe he's decided to move to Byron with the rest of the world. Anyway, yeah, that's what he's decided. So George comes to you and asks, well, should I sell the shares or should I sell the assets in the business? Working through it from a tax perspective, and we've done a very simplified balance sheet here. In terms of Metlac, because as I mentioned, one of the things that we're going to need to do is review our balance sheet. We've got assets being our business assets, of course, debtors, loan to a related entity called the 60 Trust, an investment in Staple Co, where they hold 5% of the shares, and our liabilities being an ANZ overdraft. So looking at that from a sale perspective, if we're selling the business assets, then obviously there's not much we need to do except probably get the overdraft released or paid off. So the ANZ will release, it's probably got security over the assets. If we're selling the shares or units on this page, it's unlikely that the buyer is going to want, or we are going to want the buyer to still have a loan to the 60 Trust, so that will need to be repaid. Staple Co, unrelated to the business, it's very likely we're going to have to move the investment in that out of the company before we sell the shares. And the ANZ overdraft as well. The buyer's not going to want to take that on, or if they take that on, it's going to be counted as part of the consideration that they pay. Turning to the equity section, and again, a very simplified version, we've got paid up capital of $12 and we've got retained profits of $1 million. So that's another thing that the client will very likely want to not leave in the company. If we're doing a share or unit sale, they're not going to want to leave $1 million in retained profits in the company. So we'd be looking at a pre-completion dividend to remove those. The other consideration as well, even in a business sale, would be we want to leave our selling entity with as little assets as possible, because if there's some sort of claim against us moving forward, us being Metlac, in relation to the sale of the business assets, we don't want to leave anything really valuable in that company that a disgruntled buyer could potentially get back off us in some form of court dispute.
Adrian, I'm just going to publish our second poll for the day.
Okay.
There are a couple of questions there, but I might come back to those towards the end once you finish this this part.
Sure. Thanks, Paul. All right, so thinking about our available concessions, if we're selling the business assets, discount capital gain, we're selling out of a company, we know the client can't get access to the discount capital gain. It's only operated it for 10 years, so 15-year rule would not apply. Small business 50% potentially, if we meet the basic conditions. Small business retirement, yes. Replacement asset. We know George is retiring, or his intention is to retire and live the good life. With that, it may not be an option to use the replacement asset. If he was buying another business, perhaps it would be. But in our circumstances, those are the two that we'd very likely be looking at on an asset sale. Considering the tax outcome on sale, if we're selling our assets, we have our proceeds of 1.75 million. So our gain, we're assuming, as we said, we started from scratch, so we're just giving a cost base of 0 for the assets in the company, the business assets in the company. Capital gain of 1.75 million. We, assuming George meets the maximum net asset value test or the other basic conditions, we would apply the small business 50% of 875,000 to reduce it to the gain to 875,000. George hasn't used the small business retirement exemption yet, so we could use up to 500,000 of that. He is under 55, he's 45, so we would have to pay that into super, which would leave us a gain of 375,000. Now, disclaimer here, we've applied the tax rate of 30% in all of our examples, and we recognise that there are different tax rates these days for small business entities, and they continue to change. However, just for simplicity today, we're putting all tax rates at 30%. So our tax rate at the company, or all company tax rates at 30%, I should say. Our tax rate at the company level would be 30%, which would be $112,500. So a fairly good result. When you think of a sale at 1.75 million, we're paying $112,000 in tax. However, of course, that's not the end of it. George's money is in the company. Most clients I find when they're selling their business assets, they want to take the money. Then they want to use it to either pay down debt or buy other assets, but they're not going to want to leave it sitting in the company. So if he was to take it out, of course, we're going to have some further tax in that circumstance. In thinking about that, we need to think about what's actually in the company. So we've had $500,000 of the sale proceeds that has gone out to super for the small business retirement exemption, and $112,500 that goes to the ATO. So out of our sale proceeds, we've got $1.137500 in cash. We've still got our retained profits, of course, our loan to the 60 Trust and our investment in Stableco. If George was to access the sale proceeds, we do need to remember that out of that $1.137500, there is $875,000 which is untaxed. So that's the amount that we apply the small business 50% to. So it won't have a franking credit for that amount. So we'll be paying tax in effect from $1 on that portion of the dividend. The other part is taxed. So the balance of the sale proceeds. Our result, if we take out our entire sale proceeds of $1.137500, would be conveniently, and it wasn't planned this way, exactly $500,000 in tax. So $428,000 on the untaxed amount, assuming our top marginal tax rate, and $71,000 in some change on the taxed portion. So that's really where we see one of the issues with selling the assets out of the company and applying the small business 50. What's tax-free to the company is not necessarily tax-free to our client when they want to get their hot little hands on it. So that's the first of our, not major tax issues, but first issue that will affect George in this case. So how much cash is left out of our 1.75 million at this stage? Remembering that George wants to take the money out. We've got 500,000 in super. He's 45. It's going to be a little while before he can access that, but he can certainly use it for investment. We've got 612,500 that's gone to the tax office, which leaves George with a little under $590,000 in his pocket. So when we revisit it, as I said, what's tax-free to the company in relation to the small business 50 is not tax-free to George when he takes it out. So we're left with effectively, or very close to, a third of our sale proceeds in cash, of course, plus the $500,000 in super. I mentioned before that it's very likely that George is going to want to be doing some what you'd consider preemptive asset protection work. If we have a dispute about the sale of the business, Metlac will be the entity that's involved, as well as potentially George if he's given indemnities or warranties. So it's got $1 million in retained profits. It would be a good idea to take that out. Again, if we do that, we would have some top-up tax and we'd have the balance left over for George. So the other thing we find is the clients also want to wind these things up because, you know, they've sold the business, they've retired, they don't want to have the company hanging around forever and a day, so they take it out. If we were to take it all out in one hit, because either we're worried about a claim against the business or we've just decided to, that would be our further tax for George. So our total tax bill from our sale proceeds and our retained profits being taken out is from our sale proceeds, dividend being taken out, and our retained profits is a little bit under 900,000. What about the alternative? What if George was able to proceed with the transaction by way of a share sale or an equity sale? George is the taxpayer in that circumstance. He's the sole shareholder. We know that an individual, if they've held the shares for more than 12 months, can apply the discount capital gain. If he meets the small business concessions, remembering that he can't meet the turnover test because he himself is not carrying on a business, so we'd be relying on the maximum net asset value test. We could potentially apply some of the other small business concessions, 15-year rule, small business 50%, small business retirement or replacement asset. I mentioned earlier that we would need to be doing some tidy up in relation to the balance sheet and the assets of Metlac before we sell the shares, because our buyer is going to be taking over the company. So things like the loan to the 60 Trust, investment in Staple Co, debtors, very likely they're going to want to have those paid out, the ANZ overdraft, all of those things will need to be dealt with as part of the sale process or before the sale process. And then as well as previously mentioned, sorry, I'll just go back to that slide, previously mentioned taking out the retained profits because George is unlikely to want to leave the retained profits in the company. Outcome on sale from a CGT perspective on a sale of the shares from George. He still gets the 1.75 million. Of course, the big difference in this example is that goes into his hands. We apply the discount gain that reduces it to 875,000. We then apply the small business 50%. Which reduces that to 437,500. That's below our 500,000 cap. If we put that entire amount into super, then the end result on a sale from a CGT perspective will be tax-free to George. So we had a pretty good result initially on the sale of the business assets out of the company, remembering what's tax-free to the company wasn't tax-free to George at the end. But here we've got an even better result. No tax, and all of the cash, except for the amount that goes into superannuation under the small business retirement, is in George's hands. So, remembering we couldn't apply the 15-year rule because the business has only been operated for 10 years, and also in relation to the small business rollover, George isn't going to be requiring another asset, so we wouldn't be looking to apply that. We would mentioned before we would have to do our dividend pre-completion. So our tax on that would be 271,429, same as earlier. So we would have the same tax outcome if we'd taken all of the money out after sale, all of the retained profits, I should say, after sale, as we would on our pre-completion dividend of the retained profits on a share sale. And then how much cash is left for George? Proceeds of 1.75 million less the super, which has been paid into super, leaves George with 1.3 roughly in his hands. So we can see it's a much better outcome both from a tax and more importantly from a cash perspective. George can do whatever he wants with that cash now. He doesn't have the issues of it going into the company and then taking it out by way of a dividend. So it's certainly a much better position for George to be in. Paul, we might run that last poll.
Yeah, I'll run that last poll, but now might be also a good time to ask you a couple of questions.
Sure.
So the first one, does plant and equipment meet the small business rollover replacement asset requirements?
As long as it's an asset used in the business, yes.
Okay, and a question on the small business 50% reduction. Sometimes it can be advantageous to not apply the concession in order to enable a higher level of CGT exempt contributions under the retirement concession. The question is whether this is an all or nothing approach. Can they partially apply the 50%?
So it's a good point, and one I should have mentioned. In terms of the order of that, apart from the 15-year rule, you don't have to choose to apply something. So you can choose not to apply it, or you can also change the order of how you apply things. So sometimes if there's a particular reason to get money into super, and you can get more into super using the small business retirement exemption, you may choose not to apply the small business 50 in that circumstance. So you can choose not to apply it. It's not an all or nothing. I guess in relation to the partial bit, I'm not quite sure where that's going, but yeah, by not applying it, you're going to be able to apply more of the small business retirement.
If a unit trust sold a business and applied the retirement exemption, but not the active asset or the small business 50, does the unit trust have CGT event E4 when the proceeds are paid to the unit holders?
Yes. E4 would happen whether you applied the 50% or not, because presumably you're going to be getting more than your cost base of your units because you're having a capital gain. So there is still the potential for E4 to apply there depending on the figures, but in most cases you are going to be having a higher return than the cost base of the units.
Not exactly sure of the next question. Can you use both methods to maximise the small business CGT? By Scott. I'm not exactly sure what that is alluding to. So maybe, Scott, if you can put in a little bit more. Next question, if you, in relation to the replacement asset rollover, if you apply it to an asset, presumably a depreciating asset, then I take it that it won't be depreciated.
Well, depreciation and your cost base for CGT purposes are different things. In terms of the override in relation to that, to be honest, it's not something I've actually had a look at in terms of whether you could still then depreciate it. I'd have to come back on that one.
I'll read a couple of these and we'll come back at the end.
Sure.
So I've started that last poll, so if everyone could jump in, that'd be great.
Okay. So as we can see, just touching back on that, George is left with a lot more cash in terms of the sale proceeds than on a sale of the business assets if we're doing a share sale. Now, there we go. At the end, in the same position, so by that I mean we've had our dividend of our retained profits, which we would have to do in a share sale, and we've also had it in the business assets sale because we wanted to take the retained profits out. Tax for George would be $271,000 in the equity sale, $883,000 on the asset sale. So a fairly large difference there, over $600,000 in tax. So you would think for a client, although the equity sale can be a little bit more complicated and it can be sometimes difficult to convince a buyer to proceed by way of equity sale, the difference in return in terms of the tax that's paid is fairly staggering. So it's worth the effort in those circumstances. Moving on from capital gains tax onto GST. Again, revisiting on an asset sale or an equity sale. If it's an asset sale, in most cases, we're going to meet the going concern requirements. Just remembering that there are strict requirements that we have to meet in order to qualify for it to be a going concern, in that both parties have to be registered for GST or required to be registered. And we have to have a written agreement between the parties that they're applying the going concern. Normally that will be contained in the sale document. However, like with most things in life, I have seen sale documents where it hasn't contained the going concern requirement, as in both parties haven't acknowledged that it's a going concern. So in that case, then GST would be payable. On a share sale or an equity sale, being a unit sale, it's a financial supply, so GST wouldn't be applicable in that circumstance. Just bear with me. Transfer duty or stamp duty in most states these days, apart from predominantly Queensland and WA, no duty on business assets. We do need to remember, though, that if we have land going with the business sale, if we're doing a transaction where the business premises plus the business is being sold, then there is the potential for duty to be applied to the land and the business assets in those cases. Also, if we're selling shares or units in a company, If it's land rich, so it's over the threshold in the relevant state in terms of its land holdings, again, duty can be payable there, but not normally duty payable. Where we could have some, or where we see some issues in practice, is where the business is operating in a number of states. So say, for example, we're operating in New South Wales and Queensland. There will be a part of the sale which will be subject to duty in Queensland. And in essence, it's the proportion of the turnover, I guess is the easiest way to say it, in each state. Foreign ownership, we need to be really careful with that, particularly in New South Wales, where I'm from. Not so much for selling business assets, but again, if land's involved, and residential land, so slightly off topic there. But the new foreign trust surcharges, both on acquisition and then also holding for land tax purposes, are fairly brutal, particularly in New South Wales. And we're certainly seeing that over the last few months with lots of people receiving their assessments, which have been backdated for 4 years, which are not pleasant. On for the foreign ownership part, just remembering the CGT withholding tax regime that applies. If we're selling property, we need to have a clearance certificate to confirm that we're an Australian citizen, or Australian taxpayer, I should say. Otherwise, the buyer is required to withhold CGT. So some things that we don't often think about gets more complicated if we're selling land as well as part of the transaction, which we may be doing if we're selling a farming operation, for example. Structure choice, our last point for the day. And I think it's safe to say that the days of simply saying, put everything in a trust, because it's got the most tax flexibility, are drawing closer to the end. And the main reason for that really is the small business income tax incentives that we've seen in the form of a lower tax rate. The company traditionally doesn't have access to the discount gain on sale for CGT purposes. So there has always been an arbitrage between the amount that we receive after applying the discount as an individual or a trust and the company tax rate. That gap is reducing. And if the company tax rate keeps dropping, will eventually disappear. So it is now, and we're having more conversations with clients when they're acquiring businesses and looking to set up new ventures, the discussion in relation to whether we should have a trust or whether we should have a company comes down to a few issues. One, do we have a business that we think is going to have a large capital gain? If not, maybe more suitable in a company with a trust holding the shares for asset protection and flexibility. And two, where is the funding coming from? If we're lending from another one of our companies, and I had this conversation with an accountant earlier in the week, where one of their existing companies was going to lend to the new structure. If we're lending to another company, we don't have issues with Division 7A. If we're lending to a trust, obviously we've got to repay that and pay back the cost. Pay the dividends out, so it adds further income tax cost. In that circumstance, and particularly with that business that they were buying, which was questionable as to whether it would have a large capital gain, the decision was, well, it's going to be more tax effective for the client to buy in a company. So as I said, gone, I think, are the days of simply saying put everything in a trust. We do really need to look at what is the nature of the business, what's the funding coming from, what's the long-term plan, what's the likelihood of a large capital gain in the future. That brings us to the end of the session, Paul.
Thank you, Adrian. We do have a few more questions, and thanks to everyone for putting in lots of good questions. There is probably more a comment here. Don't you have to apply the 50% general discount first?
No.
Okay. Oftentimes I would have thought it would probably be more advantageous depending on the numbers, because obviously if you can use up all of, I guess if you use the retirement exemption last, it may get you to a position where there is zero tax payable, rather than using a 50% calculation of whatever's remaining. You may still end up with a tax, I guess, a tax bill as a result of that. The business so this question, business sold in the past, owners have used both methods of an asset and equity sale, and applied to maximise the small business CGT concessions. Is this still available?
Not sure how you do.
Yeah, I think it would be very fact specific, and there would be a reason why you would do both. I would think if you've sold perhaps some assets, but not all the assets of the business. But yeah, that seems an odd one to me.
We might have to take that one offline, Paul.
Yeah, sure. So this question is around family law. Would these concessions be available in a family law settlement where one party exchanges their shares for a share of the business for, say, the house, or are different concessions available?
So technically, yes, they could apply because we're still having a taxing event. However, remembering if our tax event is because of something that has occurred under a family law order or an agreement under the family law, then there is a general CGT exemption there. So we wouldn't actually, we may not actually be having an event because we've got the exemption there. It is part of, I guess, some of the planning that if for whatever reason we want to trigger that event, then maybe we don't cover it in the family law orders, so it doesn't come under that general exemption.
Adrian, is the 15-year or retirement exemption impacted by the $1.6 million cap on superannuation?
It is, yeah.
Next question. So if a company is plant and equipment rich, there's no stamp duty in WA on an equity sale.
That's correct, yeah.
I would say, obviously, if that company is just the owner of plant and equipment, I guess if it ran a business, for example, or held land, then potentially there could be. If a financial planner sells their client book to another financial planner who already has an established business, is that a sale of a going concern? There will be no premises as part of the transfer, as the buyer has their own established business and are just buying the client book.
Again, it's going to come back to the circumstances, but I'd say in the most part, it's not going to be a going concern. If you're thinking about, say, your financial planner, quite often say you've got premises, you might have employees, you might have paraplanners, those sorts of things. If none of those things are changing as well to the new owner, then you're just selling a business asset. You're not selling a going concern.
Next question. Would you be able to explain the retirement exemption in more detail as to who qualifies to be able to use this for a company and a discretionary trust? Mm-hmm. Does the individual need to be an employee to be able to use the retirement exemption, or can the individual who receives 20% or more of a distribution who is not an employee?
Yeah, so they don't need to be an employee in order to use the small business retirement exemption. Depending on the structure we're dealing with the company or unit trust, you as in the person has to hold either 20%. Sorry, it has to hold at least 20% of what you consider to be ordinary shares or ordinary units. So with a discretionary trust, the test is there a person who has received at least 20% of the distributions of income and capital that were made in the year? So it's a little bit easier to engineer that for a discretionary trust in the year of sale, and that we can make sure that, for example, 100% of everything goes to mum and dad. That way they each get 50%. For a company or unit trust, it's a little bit simpler in that circumstance.
Next question. For accounting purposes, should the retirement exemption payment be recorded as an expense in the P&L?
I'm sorry, I'm not an accountant.
Yeah, I was hoping you'd answer that one. I don't know either. If the shares are owned by a trust, 90% rule, what if no trust profit distribution has ever been made? Are the resolutions each year sufficient? I think that's a question about, say, for example, a trust owns shares in a company. For the significant individual test, the trust needs to have one or more people who have had I guess, a 90% distribution to them. It can be in the year of sale. So obviously there will be presumably a capital gain in that year of sale, which will be distributed. If you distribute it to, like Adrian said, mum and dad, then that would be sufficient. A couple of people have asked if the session is recorded. Yes, it is, and they're all up on our website. You'll be able to go to our website. There's a section for webinars, and you'll be able to see this and all of our past sessions on various different topics. Still a few more questions coming in, Adrian. Regarding GST and going concern, can a premises be sold as a going concern if not tenanted, not business related, purely investment?
No.
So family business, 100%. Husband now wants to restructure 50% to his wife and 50% to the husband. Will that trigger CGT?
Sorry, can you repeat that?
Yeah. So I think the answer, the question is, the husband owns the company or business 100% now. They want to transfer 50% of it to their wife. Will that trigger CGT? I think the short answer is yes. Presuming if they own the shares in their own name, there's no real concessions to avoid transferring it or avoid CGT on that transfer.
Yeah, it would be a CGT event, and you'd look to use small business concessions perhaps to deal with the gain.
Yep. What implications are there regarding franking credits in the case of getting rid of the retained profits?
So just like any other normal dividend, if there are franking credits, you would use them as part of the dividend. Yeah, just like any other normal dividend.
If you restructure your business from a trust to a company, what CGT exemptions are available if essentially all ownership remains the same?
So you could either have a rollover under Division 122A, or you could use the 328G small business restructure rollover. Either of those you could use in that circumstance.
If you sold business assets held in one trust but kept the business premises held in a separate property trust, would that property trust qualify for the CGT concessions if sold later on?
As long as it continues to meet the active asset test, which, if you remember, has a time qualification as well. So that it has to be an active asset for effectively half of its life, half of its ownership life, I should say, or if it's been held for more than 15 years, for at least 7.5 years. So to use an example, and I didn't check the attendance list, so you may even be on the line, accountant selling the practice and then some years later selling the business premises. The practice had been held for long enough in the business premises that it didn't matter that at the time of the sale, it wasn't being used in the business. It qualified under the length of period it had already been active.
The next question is, can the in-specie transfer of business property to an SMSF also qualify for small business CGT concessions?
It can, yes. Not so much in specie. Sometimes with small business concessions, you can have issues with gifting, but with a super fund, they're going to have to, in effect, pay market value. But gifting, because if you're applying the market value substitution rule, then you have issues with, in effect, streaming the capital gain and making someone presently entitled to it. So, yeah, not so much an issue with super funds, but yeah, sometimes it's something to think about.
For the active asset concession to apply, the asset can be used by a related party and not necessarily the seller. That is a question. Example, a farm with a spouse running a business on the property.
Generally speaking, yes, because it can extend to an affiliate or an entity connected with you. You do have to be careful sometimes in reviewing it, because sometimes it doesn't apply.
And once a company stops being a base rate entity, i.e. because it stops trading, do dividends get franked at 30%?
I think you know this one, don't you, Paul?
Yeah, I do. Short answer is it will eventually. It's not necessarily in the year of the cessation of trading, but the way I guess the term is the maximum frankable amount. The calculation is based on your tax rate in a particular year. So if you go to a tax rate of 30%, then you do have the ability to frank at that higher rate. Obviously, there's plenty of companies that would have paid tax at 30% when the tax rate was simple to work out, and they will have franking credits trapped in that company. But depending on how long they trade at a lower rate, there may be some anomalies there where there are amounts that are not frankable. So, look, yes, in theory that does work, but it may lead to some strange outcomes. What might be the last question, Adrian? If you rolled over from a discretionary trust to a company, how are the shares allocated to shareholders on the rollover?
So if you roll over from a discretionary trust to a company, on the 122A rollover, the shares would be allocated to the trust. Small business restructure rollover, technically you wouldn't have to allocate them to the existing trust. You could allocate them to another trust, for example, or individuals. It gives you a bit more flexibility, bearing in mind there are a few more hurdles to jump with that rollover. But that's broadly the way you'd be looking at it.
Rightio. Well, thank you very much, everyone, for...
What about the polls, Paul? The polls?
Sorry?
The
polls. So let's go to the polls. In relation to the first question, has your client been involved? We had 61% say that their clients had sold the business in this year. Question 2, the highest was retirement, which probably is not surprising to most people. So I think that's probably a reason why today's session was so popular in terms of people attending and also signing up. We had 55% of clients retiring. There were a few health issues, but also succession planning and the fact that they always plan to, which probably goes into that retirement as well. So small business concessions are obviously really important for people. And what was sold? Generally a business asset sale, 61 to 39% was business assets as opposed to shares or units. So it may be, and we often see it, where clients come to you late in the piece and haven't really thought that a share sale or an equity sale might be the better way to go, and perhaps the deal was already struck. Because as we saw today, there can be some I guess, better outcomes depending on the circumstances from an equity sale. So it's worthwhile having a look at both situations. So again, thank you everyone for coming along. If we didn't get to a question, I think we did get to most of them. There might be one or two that we'll try and address after the session, but we really appreciate everyone coming along, and that's it from me.
Thanks, everybody.